This class is financial management. My name is Kirby Arcundiff. I have a Ph.D. from the University of Illinois at Urbana-Champaign. I'm a chartered financial analyst and a certified financial planner. I currently work as a chief economist and an adjunct professor of accounting and financial management. For this class, we will use the excellent text by Brigham and Davis, Intermediate Financial Management. And in this lecture on Chapter 4, we will cover the second half of the chapter on bond valuation. Now we are going to study the equation for how, at least in theory, interest rates are determined in the market. And we would say RD, the required rate of return of an investment in bonds or any other kind of debt instrument, is going to be a real risk-free rate, basically what you should be compensated at as an investor for delaying consumption. Historically, it is assumed that this is something around 3%. Of course, for shorter-term debt, and now even for longer-term debt, the U.S. government Federal Reserve System intervenes in this quite a bit, and in recent years they have driven this negative. In a free market, this would not be negative. You should also expect an inflation premium, so you should expect a compensation beyond inflation, the real risk-free rate for delaying consumption, plus an inflation premium for the fact that government is printing money, devaluing the money you have. And you should also, down here at the bottom, I'm going to skip to it, expect a maturity risk premium, because it is riskier to loan money to an individual or government over 30 years than over 1 year. You don't know if the individual, they may be a good credit risk now, but they could lose their job, they could develop cancer, they could have all sorts of problems over a 30-year period, and you want a maturity risk premium to pay for that. Same thing when lending to a government. Maybe they're responsible now and balance their budget, but over 30 years they might print lots of money causing inflation, and you should expect a maturity risk premium for lending over that time period. Now, for a government debt instrument, these are the only things that go into it. So for a government debt instrument, what we will discuss, DRP and LP are zero, and you only expect the real risk-free rate plus the inflation premium plus the maturity risk premium. For a private debt instrument, well, there's the possibility of default, so you would expect a default risk premium. This would also apply to governments like Greece, which cannot issue debt in a currency they can print, since again, the debt is in euros and they're issuing it locally and they can't print euros. The U.S. government issues in dollars and they can print dollars, so there is no default risk premium. You could also expect a liquidity premium. So liquidity premium would be something that would apply to things like small businesses. A small business, well, banks now don't keep debt on their books. So if you get a home loan from them, they can sell it to somebody else. If you get a car loan from them, they can sell it to somebody else. They're all pretty much the same. They trade them all over the country. Liquidity premiums, on the other hand, for small businesses would be added to that, because you as a local banker might know a local small business, you might know they're a very good risk, but you can't package and sell that loan to somebody else. As a result of that, that small business would have to pay a higher interest rate on their debt than a similar risk big business that would be able to sell its debt on the open market. So these two, liquidity premium and default risk premium, are added to private sector debt. For government debt, you just have R star plus IP plus MRP. What is the nominal risk-free rate? Well, the exact equation for the risk-free rate is going to be 1 plus R star times 1 plus inflation premium minus 1. This can be separated out, so you get R plus IP plus this cross term here, R star times IP, Commonly, this is considered small and left off, and you just say that the risk-free rate is R star plus IP. And this should be the rate of return on short-term Treasury securities. Close to the Fed funds rate are the Treasury bill rate, the 30-day T-bill rate. There are different ways of estimating IP. One of them would be by using Treasury inflation protected securities TIPS. They are indexed to inflation, so the IP for a particular length maturity can be approximated as the difference between the yield on a non-indexed Treasury security of that maturity minus the yield on a TIPS of that maturity. This may or may not work. It does give you an estimate. The U.S. government, of course, now engages in buying longer-term debt, just like they do short-term debt, so-called quantitative easing, so they can manipulate that market. And there can also be tax effects on that market. But this is at least an estimate of what people believe IP might be. It would be a better estimate if only individuals and private sector people were trading in long-term debt instruments instead of governments. Now we could look at things called bond spreads. A bond spread is often calculated as the difference between a corporate bond's yield and a Treasury security yield of the same maturity. Therefore, a spread could be DRP plus LP, and this could be the difference between a AAA rated private sector debt and U.S. government debt of the same maturity. Sometimes hedge funds will bet on whether or not this is going to increase or decrease. Long-term capital management, which was ran by some Nobel laureates, lost a lot of money and was sort of bailed out by guessing this wrong. So bonds of large, strong companies often have very small liquidity premiums and very small DRPs, whereas bonds of small companies often have large LPs of 2%, even if the default risk premium is close to zero. There are multiple different bond rating agencies, S&P, Fitch, and Moody's, and they all give ratings to these bonds. Internally, banks give different ratings. The internal bank ones are just like 1 through 10. The rating agency ones are more like letter grades. You can get an A+, which would be AAA, an A, which is AA, or an A-, which is single A, and then BBB is a B+. So-called junk bonds go down to B, and B- are CCC. There are regulations on which of these banks can hold. Banks can only hold investment grade. They can't hold junk, but you can invest in junk if you invest in a high yield bond fund with Vanguard or another mutual fund company. And of course, the chance of defaulting goes up significantly as we go down in the ratings. So there's basically no chance of default in AAAs, although very rarely that has occurred. And this increases gradually to a pretty high chance of default, 25% for the CCCs. And that's only over 1 year. Of course, over 5 years, the chance of default can go up. So the chance of default goes up as we go down, but it also goes up as we go from 1 year to 5 years. For example, for BBB, it goes from 0.2 to 2.45, and for CCC goes from 25% to 37%. You both have time risk and 1 year default risk. How about bond ratings and bond spreads? Well, the higher the risk of default, the higher you should require an interest rate to be paid for taking on that risk. So here's an example in December of 2013. At that point in time, 10-year T-bonds yield 2.87, and as you increase in chance of default, the interest rate required should go up. So BBBs are at 4.81 and CCCs are at 7.40, and the spread is going to be this number minus this number. So 7.4 minus 2.87 gives us a spread for the triple C's of 4.53, but the AAA of 3.65 minus 2.87 gives us a small spread of 0.78 for AAAs. So again, the spread will increase as the letter grade goes down or the chance of default goes up. So what factors affect default risk and bond ratings? Well, you can look at a lot of different things for a company. What about financial ratios? Debt ratio. If you have a company that is 90% equity and only 10% debt, there's pretty little chance of defaulting. If you've got a highly leveraged company that only has 10% equity and 90% debt, there's a pretty good chance of defaulting. Interestingly, most banks get away with having extremely high debt ratios, largely due to things like FDIC insurance and governments always bailing them out. But private companies can't get away with having as much debt as banks can. You could also look at things like coverage ratios, such as the interest coverage ratio or the EBITDA coverage ratio. This would be, for example, EBITDA over interest. The lower the interest is relative to EBITDA, or the higher the coverage ratio, the safer the investment is and the less change the default. Profitability ratios could also affect this. Profit margin, net income over sales. Well, if you have a highly profitable company, they're probably going to be able to pay their interest. If you have a company that's having problems and is losing money, they might not be able to pay their interest. How about current ratios, like current assets over current liabilities? If you have a lot of current assets, a high current ratio, then you can always liquidate those current assets to pay off your short-term debt, your current liabilities. If you have a real shortage of current assets, then you could run into liquidity problems and not be able to pay your debt, perhaps even if you have a lot of long-term assets that aren't liquid. So we can look here at median ratios for various bond ratings. For example, our return on capital ratios are going to be very high for a AAA rated company, but rather low for a triple C. Your rate of return on capital might be very low for a triple C. It might be speculative. When we go back to the 70s and the stock market had very low valuations, sometimes speculative companies would just start out by issuing junk bonds. Sprint and MCI did this. I believe so did CNN, Turner Broadcasting. But that would have been when PDE ratios on the stock market were like 8, and now they're about 30. So companies are going to finance starting up with venture capital rather than debt. So you could have a company starting out with a very bad return on capital, but expect it to grow. You could also have a fallen angel, a company that used to be doing well, now is not doing well, and its bonds have been downgraded and they have a bad return on capital. Debt to capital, again, this is going to be basically the amount of debt, the percent of debt they have versus the percent of equity. And these companies, AAAs, commonly have very little debt and a lot of equity, whereas here a triple C has a ton of debt and not very much equity. Other factors that can affect bond ratings would include provisions in the bond contract. For example, secured versus unsecured debt. A car loan or a home loan is less risky than a credit card loan because there's something to seize. A home loan is probably one of the most secure types of loans. With a car loan, of course, the car can be driven off. And with a credit card, there is nothing to seize. Senior versus subordinated debt. Senior gets paid off first, therefore it is lower risk than subordinated. There can also be guarantee provisions, similar for a corporation to you having another family member sign off and guarantee to pay the debt if you can't. Sinking fund provisions guarantee a liquidity provision in the bonds. So if it has a sinking fund, it's lower risk and therefore has a better rating, and you are always guaranteed that some of the bond will be bought back every year. The maturity of the debt on the bond can also affect the bond rating. There can be situations where longer term debt is either lower risk or higher risk as associated with the default risk premium, at least, than short-term debt. You could have a company with a lot of long-term assets that are hard to sell, and it may not be able to pay its short-term debt, or you could have the opposite, where a company has a lot of liquid assets that can pay its short-term debt, but its long-term future looks bleak. Other factors, earnings stability. Some companies are cyclical. A mining company might make a ton of money if the economy is growing, and nothing if nobody is, for example, buying steel, and that would make them higher risk than a company, perhaps even with lower earnings, but earns them on a consistent year-by-year basis. Regulatory environment. There are companies like drug companies whose future is very dependent on whether or not the FDA approves their drugs. If you are in the construction business, you can have lots of problems with getting approvals for building housing complexes or apartment buildings. And if that is delayed, well, then you may not be able to get your apartments up and rent them. You may not be able to get cash flow, and you may not be able to pay your debt. Potential product liabilities. Various companies have been sued into bankruptcy over the past. Examples could be companies that had asbestos in homes or even in car parts, and also silicone breast implant issues. So you can run into a lot of different issues, get sued, go out of business. Also, accounting policies. Do the rating agencies trust your accounting? And in recent years, of course, accounting has become more speculative than in decades past. The next topic we will discuss is interest rate risk. This was particularly relevant in the Silicon Valley Bank bankruptcy, and also in the savings and loan fiasco back in the 80s and 90s. And we will discuss those issues in detail again in another video. So if you look here, we know if interest rates go up, bond prices go down. Here we have a 1-year bond and a 10-year bond, and in the middle we have the interest rate demanded by the market of 10%, and both of these bonds pay 10% interest and trade at par. So initially we have a $1,000 1-year bond paying a $100 coupon at par with a 10% interest rate environment, or a 10-year bond paying a $100 coupon also in a 10% interest rate environment. Well, what happens if interest rates drop? Well, if interest rates drop, bond prices go up. For the 1-year bond, they will go up to $1,048. For the 10-year bond, they will go up to $1,386. You can check this on your financial calculator. For the 1-year bond, you would just put in N equals 1. Initially, you have an I equals 10, then you will change it to 5. Your payment is going to be 100. Your future value is going to be 1,000. And you will find this change or a 4.8% increase in price. The only difference for the 10-year bond, you change the N, the number of years to maturity, to 10, and you change your interest rates from 10% to 5%. Your bond goes up in value a lot more to $1,386, or a 38.6% change in price. This is why even if people don't think long-term government debt is a good investment, over the long run, they don't think the government will pay its debts over the long run. They think inflation will go up. They still might invest in long-term government debt if, for example, they think a recession is coming and short-term interest rates are going to drop, then your 30-year or your 10-year bond would go up in price significantly. The opposite of this, of course, is if interest rates go up. If interest rates go from 10% to 15%, then the price of a one-year bond goes down to $9.57 for a drop of 4.5%, but the price of the 10-year bond goes from $1,000 all the way down to $749 for a drop of 33.5%. This drop here is what wiped out the savings and loans in the 90s and what wiped out Silicon Valley Bank. So if you look at Silicon Valley Bank, they had a lot of investments in long-term government debt. Interest rates went up, the value of that debt plummeted, whereas their liabilities would be like passbook accounts, and the value of a passbook account doesn't change. So the value of the bank is going to be assets minus liabilities. The value of the assets, the long-term government debt plummeted. The value of the liabilities, the passbook stayed the same. Banks don't have a lot of equity, maybe only 10%, so it's pretty easy to wipe out Silicon Valley Bank's equity, similar to the savings and loan fiasco in the 90s. Here is a graphical representation of the same data. We have our one-year bond here and our 10-year bond here, and you can see as interest rates go up from 10% to 15%, the value of the 10-year bond drops a lot more than the value of the one-year bond. It has a lot deeper slope. Whereas if interest rates drop from 10% to 5%, the value of the 10-year bond goes up a lot more than the value of the one-year bond. If we apply this more specifically to a savings and loan, our bank, we can show that as interest rates go up, the value of the assets, the long-term, in the case of Silicon Valley Bank, debt drops drastically, government debt, or in the case of the savings and loans, the value of the long-term home mortgages drops drastically. Whereas if we look at the liabilities, the passbook accounts, if you have a passbook or checking account, well, you just get paid interest every month, and the value of your assets in that account does not go up or down except for the addition of interest, so that blue line stays the same. The equity of Silicon Valley Bank, or the savings and loan, is just the assets minus the liabilities. So you take the red line here minus the blue line here. Well, at this point in time, you have positive equity. If interest rates go up enough, the red line, the assets drop enough that the green line, the equity, is wiped out, which is what happened to Silicon Valley Bank and the savings and loans. The way accounting on banks work, they are allowed to keep debt on their books in two different categories. Held to maturity securities are available for sale securities. The available for sale securities, they have to market as interest rates go up or down on a regular basis. Whereas the held to maturity securities, they can assume that at maturity they will get the par value back, and they are not required to mark that to market. If we look right now, unrealized gains or losses on investment securities at U.S. banks, well, as interest rates went up in 2022, banks lost a lot of money on their long-term debt. The tannish section here shows what of that they have so far written off on their balance sheets, in the sense that it's shown as a loss, whereas the held to maturity securities here in blue is not shown as a loss. So we have very significant losses at the banks, $675 billion. This will be a problem for banks in the future. In the case of Silicon Valley Bank, there was a so-called run on the bank. People demanded their money back, and that forced the bank to sell securities that were listed in the held to maturity section, and therefore they had to realize those losses. That did not wipe out all the equity of the bank, but it drove the equity down to the point they were not in compliance with the Tier 1 and Tier 2 capital requirements on the Basel Accord agreements, and therefore the government basically shut them down and sold off their assets to other banks. Another risk that an investor might encounter when investing in bonds is reinvestment rate risk. This is the risk that cash flows will have to be reinvested in the future at lower rates, therefore reducing income. For an example, suppose you just won $500,000 playing the lottery or inherited $500,000 from your parents. You'll invest the money and live off the interest. You buy a one-year bond with a yield to maturity of 10%. Well, then you're going to get $50,000 the first year in interest. But let's suppose that interest rates drop drastically from 10% to 3%. Earlier you got 10% of $500,000 or $50,000 a year. Now you're only going to get 3% of $500,000 or $15,000 a year. And your income goes drastically down. If you'd bought 30-year bonds, your income would have remained constant, except you would have had to worry about inflation. So this can be incentive. For example, right now the Federal Reserve is talking about lowering interest rates. A money market might pay 5% now. In a year it might pay 4%. You could get at least a 5-year investment that might pay 4% for longer than that. So you might be inspired to buy a longer investment and take on some interest rate risk to reduce your reinvestment rate risk. More details about the maturity risk premium. Long-term bonds have high interest rate risk, low reinvestment rate risk. Short-term bonds, low interest rate risk, high reinvestment rate risk. Nothing is riskless. Yields on longer-term bonds usually are greater than on shorter-term bonds, although not always the case. You could have an inverted yield curve, which we have now. So the maturity risk premium is more affected by interest rate risk than by reinvestment rate risk. Studying how interest rates behave as a function of time, you would use the term structure yield curve. The term structure of interest rates, the relationship between interest rates and maturities, and a graph of the term structure is called the yield curve. Here is a hypothetical Treasury yield curve, the way things are sort of supposed to be, where we have years to maturity on the bottom going out to 2021, interest rates here going from 0 to 14. Investors should expect to get R star, the real risk-free rate of around 3%. They should expect to get an inflation premium above that. In this example, it showed inflation is expected to go up above a little bit over the next few years, so that goes up. And they should expect to get a maturity risk premium in red above this. So you would normally expect to have an upward sloping yield curve where you pay higher interest rates over the long run. This doesn't always happen. Here is the current Treasury yield curve in November of 2024. It is not upward sloping. It sort of goes down and goes back up. And the last 2 years, it has behaved something similar. So what messes up yield curves like this? Well, one of the big components is quantitative easing. The U.S. government, before the financial crisis in 2007, only bought or sold short-term debt and only controlled the Fed funds overnight lending rate. Now they buy the whole yield curve, and therefore they can suppress longer-term yields. They have an incentive to do this, supposedly to help the economy, also to make sure the U.S. government, the greatest debtor in the world, pays lower interest rates. Another reason you could have an inverted yield curve is if you expect the economy to go into a recession and people want to lock in longer-term interest rates and avoid risky investments like the stock market. Here are historical yield curves. The ones on the bottom are normal or upward sloping, as in 99 and 2000. The one on the top is the most famous inverted yield curve in history, when Paul Volcker massively increased short-term interest rates to get inflation under control, and he was actually successful in doing that. It did push the U.S. economy into a pretty severe recession, but then we had reasonable inflation rates for the next 30 years. Unfortunately, now we have an inflation problem again because the Fed has not been very responsible since then. But if during this time period you believed Paul Volcker, you believed you would get inflation under control, and you invested in 30-year bonds at 12%, you would have got a stock market rate of return in a much lower risk instrument, U.S. government treasury bonds, for the next 30 years. Well, what about if a company can't pay its bonds and goes into bankruptcy? There are two main chapters of the Federal Bankruptcy Act, Chapter 11, Reorganization, and Chapter 7, Liquidation. Typically, a company wants 11. They want to survive, reorganize, and continue. Creditors may prefer Chapter 7 and just sell off the assets and get at least part of their money back. If a company can't meet its obligations, can't pay its interest on its debt, it files under Chapter 11 that stops creditors from foreclosing, taking assets, and shutting down the business. The company then has 120 days to file a reorganization plan. The court appoints a trustee to supervise reorganization, and management usually stays in control. As I'm making this, one of the famous bankruptcies taking place is with InfoWars and Alex Jones, and there are lots of interesting arguments about whether or not the bankruptcy has been handled properly by the court system. If a company is in Chapter 11 bankruptcy, it must demonstrate in its reorganization plan that it is worth more alive than dead. Otherwise, a judge will order liquidation under Chapter 7, and the company's assets will be sold off and its debts will be paid as much as possible. If the company is liquidated, here is the payment priority. First, the government gets its money, past due property taxes. Then secure creditors get their money from the sale of the assets that they secure, the secured assets. Then, of course, the lawyers aren't going to handle this unless they think there's a good chance they're going to get paid, so the trustee's cost gets paid. Then expenses incurred after the bankruptcy filing, otherwise nobody would continue to work for the company. Then wages and unpaid benefit contributions subject to limits. I had a friend whose wife showed up to work and the doors were closed and she never got her paycheck for the last few weeks, so that doesn't always happen. Then unsecured customer deposits subject to limits. Then other taxes. Then unfunded pension liabilities. Of course, there are huge unfunded pension liabilities with things like Social Security that may never get paid. Then unsecured creditors, then preferred stock, and at the very end, if there's anything left over, which is unlikely, common stock. Now, well, this is the official way things are supposed to be done. All this stuff will go through the court systems. The various entities in here have attorneys, and it may turn out that this actually doesn't take place and everybody makes a deal with each other to get things done. There are also very bizarre situations like the General Motors bankruptcy, where basically the government intervened and did not allow the creditors to take over the company like they were supposed to, and instead basically took the company and gave it to the labor unions. So what's listed here may or may not actually happen through the court system, but for smaller, normal, non-political bankruptcies, it's likely to take place. I thank you for watching this video.